Next is prepayments. If accruals are the financial hangover, prepayments are the gift card from hell. This is the exact opposite problem. This is where you have actually spent the cash and it is physically gone from your bank account, but the accountants refuse to admit you've lost any money. Grab a stress ball. Let's get through this. Here's the scenario that makes non-accountants want to flip a table. You write a massive check for $120,000 to pay for your office rent for the entire year up front. You look at your bank account. It is $120,000 lighter. You feel poor. You cry a little in the bathroom. Then you get the monthly report from finance. You look at the rent expense line. It says $10,000. You scream, "What? I spent $120,000. Where is the rest of the loss?" And the accountant smiles that smug little smile and says, "Oh, don't worry. The other $110,000 isn't an expense. It's an asset." An asset? I gave the landlord my money. How is an empty bank account an asset? It feels like we're pretending to be rich while eating instant noodles because we have no cash. Let's leave the office and go to the gym. It is January 1st. You are full of motivation. You walk into Swollen Soul Fitness and you pay $1,200 for a full year membership up front because it saves you 10%.
This should cover the next year.
Wonderful, thank you. I'll get your receipt printed.
The cash reality. You are broke. You cannot buy a smoothie on the way home. The accounting reality. Did you use the gym for a year on January 1st? No, you walked on a treadmill for 15 minutes and left. If you treated that $1,200 as a loss in January, you would be emotionally devastated. You would think January was a financial disaster. But then, in February, March, and April, you walk into the gym for free. You swipe your card and pay nothing. You feel like a king. If you recorded life this way, you'd be manic-depressive, suicidal in January, euphoric in February. That is no way to live. The over-caffeinated lawyers at the Standards Board stepped in again with the matching principle. They realized that if businesses recorded huge upfront payments as immediate losses, their profits would look like a roller coaster. January, massive loss because we paid rent or insurance for the year. February to December, massive profit as we have no expenses. This is stupid. It tells you nothing about how the business is actually performing day to day. So we use prepayments. It's basically a storage locker for value. Every month, as you use the gym, we take $100 out of the asset locker and move it to the expense bucket. We're spreading the pain to match the gain. Here is the takeaway to keep you sane. Prepayments are just expenses waiting to find their turn to die. They sit on your balance sheet looking like assets, but they're really just future costs that you've already taken care of. The trap: do not look at your total assets and get excited about the prepayments number. You can't spend a prepaid rent asset. You can't buy lunch with prepaid insurance. It is dead money. So, next time an accountant tells you your empty bank account is actually a current asset, don't punch them. Just nod and say, "Ah, yes, amortizing the economic benefit over the useful life." They'll be so terrified you know those words, they'll leave you alone for a week.